The key to having success investing in the stock market is, of course, picking the right stocks and ETFs to hold on to long term. And although this seems easy on the surface, building a successful investment portfolio can honestly be pretty overwhelming, and this is because of things like single stocks having the allure of big gains in a short amount of time, but keep in mind this can also come along with significant risk. On the other hand of single stocks, we of course have exchange-traded funds or ETFs that have become more and more popular over the years due to things like the diversification benefits and lowering your risk to potential exposure to any single name. Now in this video, we're going to go over, in my opinion, one of the best high quality dividend growth ETFs across the entire stock market, and also explain just how a $25,000, yes, a $25,000 investment into this beast of a dividend growth ETF could not only set you up long into the future, but also potentially your family and your family's family. Now stick around, drop a like down below, and let's get right into it. So of course, if you have not realized by the title of the video yet, we're talking about the Schwab US Dividend Equity ETF, known as ticker symbol SCHD. Now before we break down the exact math on how just a $25,000 investment into something like the Schwab US Dividend Equity ETF could not only set you but your family up in the future, let's quick dig a little bit deeper into the Schwab US Dividend Equity ETF, learn how it works, but also give you as an investor all the information you need. Now the expense ratio of this ETF is one of the selling points that a lot of investors enjoy when it comes to this ETF. The expense ratio for this ETF is just 0.06%, which makes this ETF very cheap to hold on to for how much value it offers in my opinion. Now the summary objective of this ETF is very important, and I don't think a lot of dividend growth investors that even own this ETF truly understand how it works. The ETF's objective says the fund's goal is to track as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index. And we're going to dig into the Dow Jones US Dividend 100 Index very closely here in a minute, which is important because, once again, that's exactly the objective of this ETF. It's to track all the different stocks within this given index, which I think some investors might miss. Now some highlights of the fund: a straightforward low-cost fund offering potential tax efficiency. The fund can serve as part of the core or complement a diversified portfolio, and it tracks an index focused on quality and sustainability of dividends. And it also invests in stocks selected on fundamental strength relative to their peers based on financial ratios. So the way that stocks enter the Dow Jones US Dividend 100 Index is a pretty complex process, and it is based on things like financial ratios and strength and other things, which we are going to dig into soon. So in due time, you are going to understand exactly how stocks even get into the SCHD ETF, which is going to be very important on whether or not you want to invest in something like this. Now, a few other important facts when it comes to SCHD. Like we said, this fund started in October of 2011, so it's around 13 years old as of right now. The total net assets is $47.5 billion, making it one of the biggest ETFs in the world, and in my opinion, for good reason. So next, before we go over anything else, I think it's really important to actually dig a little bit deeper into the Dow Jones US Dividend 100 Index, which is the exact index that the SCHD ETF tracks. And to dig a little bit deeper into it, let's head over to the methodology and learn how this index works, learn how stocks are added or taken away, etc. So now that we are in the Dow Jones US Dividend 100 Index methodology, it says Index Universe. The Index Universe is defined as the constituents of the Dow Jones US broad stock market excluding REITs. So you are not going to find REITs in this index, even if they were to match some of the criteria. Now stocks must pass the following screens, which is part of the reason why I like the SCHD ETF and the Dow Jones US Dividend 100 Index, is because the screen is pretty strict. It says minimum 10 consecutive years of dividend payments, minimum FMC of US 500 million, minimum 3-month ADVT of US 2 million. Now, index construction, constituent selection is as follows. Number 1, the eligible securities are ranked by each of the 4 fundamental base characteristics. Things like free cash flow to total debt, annual net cash flow from operating activities divided by total debt. Companies with zero total debt are ranked first, which we like. Return on equity, annual net income divided by total shareholder equity. IAD yield, also 5-year dividend growth rate defined as this formula below. Now number 2, the 4 rankings are equally weighted to create a composite score, and the eligible securities are ranked based on the composite score. Number 3, the top 100 ranked stocks by the composite score are selected to the index subject to the following buffer rules that favor current constituents during the annual review. So looking at the top holdings, this is going to be weighted by market value. So the biggest positions are going to be the top and the smallest are going to be the bottom. So looking at some of the top holdings, we have companies like Amgen Inc., AbbVie Inc., Chevron Corp., Merck, companies like Pfizer, Cisco, Texas Instrument, Pepsi, Verizon, UPS, The Home Depot, Coca-Cola, companies like Lockheed Martin, Altria, Blackstone, 3M, Ford Motor. To look a little bit deeper into dividends, where SCHD sits right now, it's offering around 3.7% trailing 12-month dividend yield, which is pretty outstanding considering you are buying into an ETF that does have some growth potential. It's not only going to pay you a nice, pretty dividend. But what's even more important when it comes to SCHD, in my opinion, is the dividend growth rate, which is basically how much a stock or an ETF pays as far as dividends compared to the previous year. So for example, over the last year, this ETF has raised the dividend around 5.7% over the last 12 months or so. But if we were to zoom out even further over the last 3 years, 11.44% dividend growth rate, which is outstanding, 13.69% over the last 5 years, and around 11% over the last 10 years, which is really, really good. Now to get an even more visual look at this, you can see it very simply here. Back in 2011, when SCHD paid out the first dividend ever, the quarterly dividend payment was 12 cents per share per quarter. But quickly after that, it moved up to 14 cents per share per quarter. Then 1 quarter after that, 21 cents per share per quarter. And if you look around 12 years ahead of time, now this ETF is paying anywhere from 70 cents to 65 cents as of the last dividend per share per quarter. So what this means is very, very simple. If you were to have purchased this ETF, let's say in 2011, and just held onto your shares, let's say you bought 10 shares at $25 or $26 per share, and you just held onto your shares for the last 13 or so years, you would be getting paid more and more for the most part, every single quarter, more or less, as time went on, which is the absolute beauty of dividend growth. So now that we dug a little bit deeper into the SCHD ETF, looked at what some of the top holdings are, and even how some of the top holdings become a part of the index. What I'm going to show you next is going to blow your mind if you've never messed around with a dividend calculator and saw the power of compounding right in front of your eyes. Now, in this dividend calculator, we are going to type in a $25,000 starting principal investment into the SCHD ETF, let's just say. On top of that, we're going to go with a $1,200 annual contribution, which is just $100 per month. So this means that over the years, you are basically saying that I'm going to start off with $25,000 into SCHD, but on top of that, I'm also willing to add $100 more a month into the ETF long term. Now, of course, annual contribution could be more. You could, of course, add $12,000 per year, or of course, you would have $12 per year. But just for this example, in this video's sake, we're going to go with a $25,000 starting principal and $1,200 per year. Now, on top of that, the SCHD ETF has around a 3.8% initial starting dividend yield. Of course, this could be a little bit off moving forward. Who knows what SCHD is going to pay the next few quarters? But once again, just for example's sake, let's go with 3.8%. And then as far as the expected annual dividend amount increase, we're going to go with 8%. Now, as far as dividend growth goes, this right here is the dividend growth history when it comes to SCHD. So as you see right here, the annual payout growth year over year has been anywhere from 11%, 15%, 9%, even down to 6.9%. So by using the 8% expected annual dividend amount increase, I feel like we could even be undershooting a little bit. Now, with an expected annual share price appreciation, this is again completely unknown, but let's go with 3%. The distributions are going to be quarterly. That's how frequent SCHD pays out their dividends. And then DRIP or dividend reinvestment is going to be turned on. So that means on an ongoing basis, whatever dividends are received along the way throughout the 40-year journey that we're going to be looking at, all the dividends in the meantime, for this example, are going to be turned on. And of course, I definitely recommend all of you to mess around with dividend calculators on your own and see what works for you. So the numbers are in, guys, and let's check it out. By year number 1, $25,000 principal of SCHD is going to earn somewhere around $963 per year in dividends. Not all that much, not enough, of course, to change your life or, of course, change your family's life. But keep in mind, this is just year 1. Year number 2, $27,700 and around $1,100 per year in dividends. Year number 3, $30,700 in principal and around $1,300 per year in dividends. By year number 5, skipping down a few, $37,000 and around $1,700 per year in dividends. So from year number 1 to year number 5, it's going to look like things are starting off on a slow basis. And that's because the power of compounding really kicks in later on down the line. As the numbers get bigger, the yield on cost gets higher. And of course, as you get paid out more and more in dividends, and as those dividends get reinvested year after year after year, that is going to be the snowball effect taking place. So by year number 10, this investor would have $60,000 and around $3,600 per year in dividends. So keep in mind, this example, once again, is for a relatively younger investor. If you started this when you were, say, 60 years old, then this, of course, would not make sense. But if you're watching this video, I'm sure you're probably anywhere from maybe 18 to 35 years old. And in that case, this is the perfect amount of time frame if you would potentially like to change your and your family's future. Now, 15 years in, it takes around 15 years for this portfolio to gather enough principal to be around $100,000 in principal and around $7,400 per year in dividends. Now from year number 15 to 25, you are going to see the numbers go from $109,000, $120,000, $134,000, $150,000, and the dividends go from around $10,000, $11,000, $13,000, $16,000, $19,000. So as I promised, as the years go on and the numbers get bigger, they're going to really start compounding. And with just a $25,000 initial investment, by year number 28, we're talking about $300,000 invested with around $38,000 in dividends. Now, it's also important to keep in mind, these numbers are going to be much, much bigger if an investor was to say start off with more or say add more in on a consistent basis. But once again, this gives you an idea of what we're working with. So by year number 30, if a 20-year-old started this, by the time they're 50, they would have around $609,000 in principal and $96,000 a year in dividends. This is the amount of dividends an investor would have every single year, just going off the numbers that SCHD, for example, is offering right now. Now, the crazy thing is let's say in 30 years from now, you want to start passing on this portfolio, say to your kids or your grandkids, whatever it might be. By this point, the portfolio is going to start growing exponentially fast because at this point, you are reinvesting, per se, $96,000 back into the portfolio, and then you're getting paid dividends on that money. And you can see how the snowball effect is really, really working now. So by year number 40, in theory, this investor would have around $3.83 million and around $1 million per year in dividends. Now, before you say things like, well, I don't want to wait 40 years, or things like, who knows what SCHD is going to pay in the future, and things like past performance doesn't guarantee future performance, you're right about all of those things. But if one thing's for certain, all I want you to take away from this is that the power of compounding is real. And as long as you can stick with an investment and keep reinvesting long enough, regardless of really where you start, the numbers are going to get bigger and bigger and bigger long term. But now I want to hear from you guys down below. If you currently are building a portfolio that you're looking to use later on in life for your family and your family's family, what is your number one largest position as of right now? Drop the ticker in the comments down below. If you enjoyed this video, make sure to please drop a like and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.